Welcome back to Simply Money. Today we're going to be looking at investing in your future. Whether you are an experienced investor or just beginning your financial journey, we're going to look at valuable insights on how to grow your wealth. So join me as we dive into the wonderful world of investing. Investing is crucial to securing your financial future. Whether it's for retirement, early retirement, buying a home, starting a business, learning how to invest, where to invest is vital. But the critical part is consistency and time. The two-step formula of consistently investing over a long period of time is the surest way to achieve financial freedom. There is no magical formula. It's a matter of consistent behavior. Remember, time is your greatest ally when it comes to investing. We have another video we've done completely on the power of compounding interest. Check that out below, and how time impacts that exponentially. I encourage you to check that out if you want more information. But for today, we're just going to focus on consistency and time as your number one key to reaching financial freedom. There are various types of investments to look into, whether it's stocks, bonds, mutual funds, index funds, ETFs, real estate. There are so many things that you can look at, and it can be overwhelming for many people. That's the whole reason I began this channel, is to help break down some of the more complex things and put it in a simpler way for people to digest. There is not a right formula. I'm not here to tell you what you should or should not do. I'm here to provide you valuable insights and knowledge for you to make an informed decision for what's best for you and the goals you have in reaching your financial freedom. Each investment type has its own risk and rewards, and you have to be aware of those and understand those and be prepared to deal with those. It's important to diversify your portfolio, to make sure that your investments are spread across different assets. Because if you watch and pay attention to the news, you'll see, for example, in 2008 when the housing market crashed, if you were in real estate alone, you could have lost everything. We're in the early 2000s, the dot-com bubble. Those that were strictly in technology stocks lost so much. It's important to diversify, whether it's diversified in different markets, different asset classes, whatever the case may be. You need to make sure you're diversified and that you minimize your risk through that diversification. A well-balanced portfolio can help you weather financial storms and reach your financial goals. Before you even start investing, it's important to set your goals. You need to understand what the goals are you want to achieve in order to better prepare on how you should be investing, how much you should be investing. Determine what goals you want to reach and how much money you'll need to reach those goals. This will help you create a tailored investment strategy to reach your objectives. Again, you can listen to other people, but you are not trying to reach their goals, so you need to have your own goals. Remember, be realistic and be willing to adjust and change your goals based on your financial situation. Things change. Maybe you lost your job. Maybe you decided that at this point in your life, you want to take a job that's less stressful, but it pays less. Maybe that changes your long-term goal. It's okay to reevaluate. Don't be so set in stone that you don't give yourself any room to fluctuate and to change. Constantly be reevaluating, whether it be on a quarterly or annual basis, on what your goals are, how you're progressing on them, and what changes need to be made to continue to establish and set and achieve your goals. Something that's not mentioned a lot is choosing the right investment platform. I have a video where I compare things like the IRA, the 401k as a cookie jar, and then the funds within them, whether it be stocks or index funds or mutual funds, as the individual cookies. The cookies are what you're actually invested in. The 401k are just accounts holding your cookies. But the platform is who is providing you with the 401k, the HSA, the IRA. There are some really good ones out there, some well-known names like Charles Schwab, Fidelity. Those are some of the bigger ones you'll hear about, Vanguard. I use M1 Finance. There's a link below. I highly recommend them. It's very user-friendly. They have a lot of options, and their customer service is number one. But the thing you need to be aware of, what works for you, whether it's the fees that you need to look at, whether it's the usability, the platform, is it available on your phone, on your computer? Do they have old-fashioned, you can send it snail mail, get your records that way? You you need to decide what works best for you when it comes to choosing the platform where you're going to hold your account, which will hold your investments. If you're already investing, I'm curious, what platform do you use? Are you with one of the well-known like Charles Schwab, Vanguard, Fidelity, or maybe M1 yourself? Place a comment below so we can see what other people are using. It'll be a great resource for those watching. Thank you. You also need to stay informed and make adjustments. We've talked about the adjustments, but if you're not informed, if you're not following market trends and understanding what's going on, your investments could be in danger. You don't just invest in a company and let it sit and never deal with it. No, you shouldn't watch it every day, and you shouldn't jump in and out of it based on small fluctuations. And yes, 20% drops in the market is a small fluctuation in the grand scheme of things. I'm talking about making adjustments when the market sector or a particular company is going completely the opposite direction of why you got into it. That's why I always encourage people to focus on index funds. They're as passive as you can get. They're set and they make the adjustments for you. You need to do your initial homework, making sure you're not overpaying in fees, making sure that you're diversified, and looking at those things. But once you invest in it, there's not a lot that you need to do. Yes, it's good to evaluate it, make sure that it's continuing to follow the rules and the methodologies that were set up. But overall, there's not a lot of maintenance that's required. It's very passive. Whereas when you're buying individual stocks, you need to stay abreast of what's happening with that company. You need to understand their financials. You need to understand their forecast. You need to understand their leadership. There's a lot that goes into buying and investing in individual stock. That's why a diversified index fund, or if you're more comfortable with a mutual fund that is managed for you, that's fine. Just be aware with mutual funds, you're paying a higher fee for an advisor to manage that for you. And statistically, index funds outperform managed mutual funds 80% of the time. Remember, investing is a long-term journey. It's a lifelong journey because not only are you investing for your financial freedom and future, once you reach that, you have to continue to manage that money in those investments to make sure it lasts so you can continue in your financial freedom. That's why learning is a lifelong process. You should be engulfing yourself in learning and understanding what your investments are in, what your goals are, and the best ways to achieve those. Don't get caught up in the hype. I have a video coming out soon on the dangers of cryptocurrency because it's the big hype and there's a lot of dangers to be had in that. Don't be looking for the quick dollar. Don't be looking for the grandiose, the great returns. Look for the steady, the safe, the consistent returns. Everyone looking for the home run strikes out more often than not. You only hear about those who win. You don't hear about the hundreds who lose. By following these simple steps, you'll be well on your way to your financial future and the freedom that you're seeking. That financial freedom. The true meaning of wealth is financial freedom. Remember, the key to successful investing is starting early and staying consistent. And if you're older, maybe you're in your 40s, 50s, or 60s, and you say, well, I can't start early. It's already gone. The best time to start is now. Stay consistent from here on forward and continually learn. Always be learning more about investing and understanding the process. So if you're an experienced investor, keep on chugging along. Keep on pushing toward your financial freedom. If you are just beginning, take that first step and begin to make your plan to reach your financial freedom. Set your goal and be prepared for consistency, and you will achieve your financial freedom. It will be here before you realize it. Thank you for watching Simply Money. If you have a chance, hit that like button. I look forward to hearing your comments and how I can better prepare you for your financial journey. Don't forget to subscribe and hit the notify button so you'll be notified when the next video is coming out. And I'll see you next time on Simply Money.